Disney just out with quarterly results, reporting earnings of $1.21 per share. It's better than the $1.10 expected. It beat pretty much on every estimate, but we should also mention that revenue saw a slight miss. Joining us right now, Hugh Johnston is with us, Disney's CFO. Hugh, good morning to you. Let's walk through the numbers for those investors out there trying to understand what's happening at the firm. As I mentioned, you did beat on every estimate on the profit end of things, but revenue, I should say, did miss, but just slightly.
Yeah, good morning, Andrew. Great to be with you guys. It was really another strong quarter for Disney. We feel terrific about it. Operating income grew 17%, EPS grew 30%, and as you noted earlier, was 11 cents ahead of Wall Street. Maybe most heartening of all was the improvement in direct-to-consumer streaming. Last year, that business lost about $600 million, and the entertainment portion actually made $47 million. That's a couple of quarters ahead of what we said. We said we'd get there in Q4. We got there in Q2. Overall, streaming was up 12%, which led entertainment to 5% revenue growth for the quarter. And then, of course, the experiences business was terrific again. 10% revenue growth, 12% OI growth. Overall, good strength in the company, and we feel terrific about the momentum we have right now.
So let's break down some of this. The first piece is Bob Iger saying that you will be profitable on the streaming side by the end of the fourth quarter. Is that right?
That's still correct. Absolutely. We'll go down a little bit in Q3 based on some ICC cricket rights out of India, and then in Q4 we will be back to profitability, and we'll build on that in 25.
And what are you seeing in terms of just the strength of the consumer? Obviously, you look at the experiences business, for example, and it seems to be holding up. Are you seeing any distinction? Because we talked to a number of CEOs who talk about people trying to trade down. It's a little bit harder to trade down at one of your experiences, but I don't know. Are people buying less lunch? What are you seeing?
We don't see much of that. I understand what's going on broadly with the consumer, and certainly the consumer who's at the lower deciles of income it appears to be making more choices around how they spend their money. We're not seeing a lot of that right now. We tend to play a little bit higher income, and as a result, we don't see a lot of trade down at this point. If anything, as consumers decide to consolidate their streaming services, we may be the beneficiaries to some degree of that.
Can we talk about sports? Because, as you know, the NBA rights are in play. I don't know how much color you may or may not want to give us on where those negotiations stand. But as you see sports going forward and the amount of money that you're going to have to spend on rights like the NBA, what kind of profit margin you can expect out of that group?
Yeah, I think, the sports business is a super strong business. ESPN has about a 35% market share of sports, obviously the biggest player in sports. And I expect we're going to continue to choose to get the rights that we need to make ESPN a strong performer. Where there are other things, we may choose to either carve off a little piece of a sports right, or we may give up certain things. As we look into the future, there may be things that are less relevant to the portfolio. In terms of the NBA, they've been a terrific partner. We're important to them. They're important to us. And we expect to continue to have a good relationship with them going into the future.
We're looking at some of the linear numbers, and they do continue to come down. How far do you think they ultimately come down? Do you think that there's a plateau where they plateau out, or do you think it's just a long-term straight line down at this point?
No, I do believe you have to see some flattening at some point because people choose cable for reasons other than just the fact that they're going to pay a little bit more. It may be that their access to broadband. It may be they're not comfortable making the technology switch. There is a convenience factor there. So I do think at some point it starts to flatten out. We haven't seen that point yet, but I wouldn't be surprised if we see that in the next couple of years.
I think Joe's got a question for you.
Yeah, I'm just trying to figure out streaming, Hugh. It'd be nice to be profitable, obviously. Andrew referred to it as the holy grail for the fourth quarter. I mean, okay, so you break even, you're slightly profitable. Do you see 20% growth year after year at some point? Does it ever get past digital nickels that we traded for analog dollars? Does that happen?
I think it does, Joe. It's a great question. Look, the overall entertainment business is a fundamentally healthy business, right? You basically see eyeballs moving from one channel to another channel, in effect, going from cable to digital. Obviously, there's margin implications initially, but as we scale over time, I think we ought to be able to equalize those margins out or at least get them closer so it becomes less of a factor for us. So, yeah, I actually think that building that streaming business and making it into an important growth driver for the company is a really good idea because the margins are going to be there for us. Now, what do we have to do in order to do that? We need to deliver quality programming. We need terrific engagement, and obviously bundling helps a lot with that. We need to work on password sharing because that's actually a terrific growth driver for us. We need to get our distribution costs down, and we need to use technology so that we can market directly to consumers and also give them good recommendation engines. By virtue of doing that and ultimately building out an international business, I think it's going to be one of the great growth businesses for the Walt Disney Company.
Hugh, can you, though, speak to the balance between the streaming business and the linear business? It actually has come up in the context even of this debate over the rights for the NBA in terms of how important linear is going to be. You know, there's talk that NBC, our parent company, is going to be one of the buyers potentially to take it away from Warner. We'll see whether that happens. But part of that calculus is that they would put more of those programs on linear, on network, at the same time that they might put some on streaming. So how are you going to be thinking about the balance between the programming and original programming, live sports, for example, that's going to go direct on streaming and only exclusively on streaming versus the linear piece?
Well, I mean, we've actually been quite successful, and I won't speak to Comcast strategy, but we've actually been quite successful putting things on ESPN and also on ABC, whether it's the NBA or the NFL. We did that a few times in the fall. I actually think there's a good balance. Part of the reason for that is you really have very different audiences between linear and the streaming businesses. The streaming business, on average, is about 20 years younger than the linear businesses. So I think you can actually reach more by leveraging both. I view them both as incredibly valuable assets for us in terms of reaching the most people that we possibly can.
How concerned are you about the competition in the context of some of the big tech companies and Netflix when it comes to live programming? Netflix, for example, was not engaged in live programming. Just recently, this past weekend, they produced the Tom Brady roast, which I think went viral and it has great success. They've got this big fight coming up this summer as well. Obviously, you're putting certain sports on streaming. Peacock is doing it, too. Again, there's a larger question. If you're competing with the tech folks from an economic perspective, their economics may be different than yours.
Yeah, I mean, we're always going to have to deal with competition coming at it from differential economics, right? Whether it's the differential economics of a linear or of a streaming-only business or someone who's in the technology business that has a broader set of economics to leverage. That said, I think the core strengths of our company, in particular the IP that we own and our position in sports, give us pretty good strengths as we're competing with those guys as well. So I would expect that we'll continue to see good, healthy competition in this industry for a long, long time.